Hi students, I'm going to do a quick recording of the feedback on your second assignment for you, just so that you guys have got it already, because I'll probably, if I don't do it this afternoon, I won't be able to get to it until late tomorrow afternoon. So at least you will have this to work with tomorrow for your revision. I'm just going to do a quick run through of it, nothing in detail. Just so that you've got access to it. And as always, I'm going to be pointing out the areas where the students most commonly made errors. Okay, so I'm going to share my screen and then go to the question paper now so that we can see. Okay, so this is INAC, your second assignment, feedback on the answers that you should have got for your paper. All right, so the first one, 1.1, name the two ways or the two bases or bases on which a company can register for VAT, and give a brief explanation of the main differences between the two bases. So as I said in the prep for your assignment, this is one of your learning objectives. So you guys should go to your learning unit, which is learning unit 3, the learning unit on VAT, and read through what are your learning objectives. And in those learning objectives, you would have seen that one of the learning objectives, and let me just see if I can find it here quickly without wasting time. Where are you? Learning unit 3. It says, compare the two bases according to which vendors may be registered for VAT. So that means in the learning objectives, you should then have prepared for that, and you should know where to go and look for it. So if you go to your LU3, page 75, and we go near the beginning of the chapter, just after the VAT supply category, so on page 83 of the textbook, big heading that says payments versus invoice basis. And underneath that, it says there are two bases upon which a business can register for VAT, namely the payments, in brackets cash, or the invoice basis. So it is, and then there's a long explanation on how the payments basis work and how the invoice basis works. So in your textbooks, it's clearly indicated in the learning objectives and in the text that you should have matched up to this question. So it really is, guys, beyond me how some students can get questions like this incorrect and just take what looks to me like a guess. Okay, so you have to pay attention to your curriculum as they've given it to you, because that's what they're going to ask. Okay, so that is what you should have got. And then there were 2.5 marks for each, explaining each basis and what the difference is between them. The one I want to spend a little bit longer on looking at the answers to is this 1.2, which is which VAT supply category will apply for each scenario below, and give a reason for your answer. Okay, so this was the question, which VAT supply category will apply? And then also, secondly, you had to give a reason for your answer. So there were two things that we had to do here. Number one, name the VAT supply category. And then secondly, explain why we had chosen that. And then thirdly, they've got here also, so that's a wobbly 3, can input VAT be claimed or not by the tuck shop on the purchase? So you had to give all 3 parts of that answer in order to get the full 2.5 marks for each of these scenarios. So prior to you guys having to hand in your assignment, I did post in your announcements an online link that gave you the absolute latest version of the 0 rated items, because I think it was in 2018 the list of 0 rated items was updated, and there were a few things that were added there, one of which was white flour. So white flour of any kind, whether it's going to be used for bread or for cake. Okay, that was not previously zero rated, and it is now a zero rated item. So I gave you that link so that you had all the information right there. You didn't even have to go and search for it on the internet. It was given to you, and I was quite disappointed in how the students did this particular question. Again, you've got to, and I know it's difficult when you are starting out. You really have to remember the VAT categories have got strict parameters or criteria and a strict list for each one. So as long as you carefully test what you've got in front of you against the list, you should then be able to easily identify which category will apply and whether the company is allowed to claim or not. Okay, so also just remember, this is one part that a lot of the students got. If there is no VAT added to an item that a business purchases, for instance, a zero rated or an exempt item, then the business cannot claim any VAT back because there is no VAT to claim back. If no VAT was paid when you purchased the item, then there is no VAT to claim back because the item was a zero rated or VAT exempt item. So a lot of students in some of these questions, they correctly identified that it was a zero rated item, but then they said, yes, the business can claim the VAT. So like, which VAT are they going to claim back if it's a zero rated item? There's no VAT to claim back. So you must also use your common sense and really think about what you are answering in terms of the question. So let's take a quick look at the individual scenarios. So in our scenario 1, it was white bread. Okay, so bread is a completed product. It's a pre-made product, processed item. Excuse me, it was purchased by the tuck shop to make sandwiches to sell. So that is the two important things here, is that it's white bread. So first of all, we know that white bread is not exempt, it's not zero rated, it is a standard. Let's see if I can get it a little bit closer to where you can read it. It is a standard rated item, white bread, okay? Which means that when the tuck shop purchased that white bread, they would have paid VAT when they purchased it. So now our question is, can they claim this VAT back or not on the purchase? So because they are using the white bread as one of their ingredients to make sandwiches that they are then going to sell to the student, so the student is then going to be the final consumer of the product, so that the tuck shop is not the final consumer of the white bread, the student is going to be the final consumer. That means that the shop is allowed to claim the VAT back on that white bread because they are using it as one of the inputs into making the item that they in turn are selling on to their customer. So because it is then a legitimate business expense that they have to incur in order to earn a profit or earn a living, they're allowed to claim that white bread back. Okay. Then scenario 2, this is white bread flour. So white bread and white bread flour are two different things. The flour was purchased by the tuck shop and they're going to make muffins also to sell to students on campus. So this is slightly different in that white bread flour is currently a zero rated item. It used to be a standard rated item, but in 2018, the government also made all flour that is used to make bread, etc., also zero rated to assist people who purchase flour to make their own bread, because that's the cheapest way for them to get access to bread. So whether it's white bread flour or brown bread flour, they are allowed to, it is zero rated. No VAT is added to that. So again, the shop is using that white bread flour in order to make an item that they in turn are going to sell to the students. So they are consuming that white bread in as a legitimate business expense in running their business. But because white bread flour is zero rated, there is no VAT to claim. Okay, so no. Give a reason. Can input VAT be claimed or not? The answer there is no, it can't be claimed because there is no VAT that was charged in the first place. If this component that they used to make their muffins had have been a standard rated item, then yes, they would have been allowed to claim it back because they were using it to make a saleable item. Okay, do you understand the difference between that, why we said no, they can't claim the VAT back? That was one of the most common errors that students made in this question. Then scenario 3, we've now got brown bread. It was purchased by the tuck shop to make sandwiches, also to sell to students. So this is basically identical to scenario 2, brown bread as a finished product, but because it's brown bread, it is zero rated. And again, because it's zero rated, even though they would have been allowed to claim VAT if it was not a zero rated item, because they're using the bread to make a sandwich they are then going to sell to their customers, there is no VAT to claim. So therefore the answer is no, VAT cannot be claimed. Okay, I do understand where the students got muddled up with that. So because it's zero rated, because they were making the muffins and the sandwiches to sell to students, that told you that yes, they're allowed to claim the VAT, which is true, except in that in this case, in these two cases, there was no VAT to claim. So no, they can't claim any VAT back. And then the last one, scenario 4, white bread. So again, as we saw in scenario 1, white bread is a standard rated item, which means that is added to bread to this white bread when the tuck shop purchased it. But in this case, they are making sandwiches for the tuck shop staff to enjoy during their breaks. So in other words, it is the tuck shop staff themselves consuming the white bread. So therefore, it is not a business expense. It is then classified as entertainment. We use the word entertainment. We use the word entertainment, but it's kind of used loosely. Entertainment in inverted commas as such. In other words, it is not an essential business expense that they have to incur in order to be able to make their sandwiches to sell. It is a privilege and a concession that they give to their staff, that they make them free sandwiches and allow them to eat them during their break. So therefore, white bread is standard rated. But the answer is no, they are not allowed to claim the VAT back because they are consuming those sandwiches themselves. It's classified as entertainment. In other words, remember, it falls under the non-allowable category. Okay. So just have a look at these answers again and look clearly again at what the answers were. This was, you all made very brave attempts at this question and tried hard. So don't feel bad if you got some of these wrong. They can be tricky when you start getting used to it, as long as you've understood my explanation now of what the answers, how the answer should have been done. And I just want to make a comment here. This particular question, I noticed that there were several students that had very clearly used AI and typed these questions into AI to obviously ChatGPT to generate answers for them. And then they had just taken the answers generated by the AI and pasted them directly into their answer books. So guys, that is out and out cheating. It is plagiarism. apart from the fact that you've got someone else to do your work for you, those students also did not use any referencing to state that they had got those answers off the internet. I did make notes on those students' papers, and there were some others as well that I suspected used AI, and I'm sure there were others. So please take this as warning. We do pick it up if you've used AI. It's very easy to see, particularly if you haven't even bothered to edit the answer that the ChatGPT gave you in terms of they need to know which jurisdiction you're talking about before they can state where the input. It was really very badly done, those students. In first year, you get a warning and you get marks deducted. If you do the same thing in second year, you will go into the disciplinary process for doing that same thing. Okay, so just be warned. We do pick it up, and it is not allowed, and you will be disciplined in terms of they'll give you a first offense warning and a second offense warning in second year, and then you can be suspended or get 0 for your paper. Be very careful, guys. All of the lecturers we've all been trained, and everybody is well aware of the ChatGPT issue and students using it in assignments. Okay, so let's go on to our question 2. This one was for, see Daisy, 15 marks. And with this one here, we had to do some calculations to calculate the missing amounts. So over here, we had to calculate the missing amounts, show all your workings. Very important, please do that, and round to 2 decimal places. Very important, please do that if they've asked. And this one said ignore VAT, because in this particular question, they just were testing your markup calculations in terms of markup on cost or markup on selling price. So let me just go to the answers. So here you can see 1.1, we wanted you to say the payments or the cash basis and explain what that is, how it works, and the invoice basis and explain how that works. And here are the answers to 1.2 for your 4 scenarios. Okay, I've gone through that already. So hopefully you guys are all right with that. And then here are the answers. So we don't have the calculations here. Let me just see if I can do some of these for you quickly. Excuse me, guys. Let's go there. Okay, so I'm just going to leave this on the screen for a moment so that you can get the rand values of what the answers should have been. And then I'm going to go back to the question paper where you can see the grids where the missing amounts were, so that I can show you how you should have done the calculation, on what basis your calculation should have been done. So remember, as I told you in the preparation for this, we use a basic calculation, which says, if I do it this way around, cost plus, and then we either call it the gross profit or we call it the profit, or it can be called the markup. But in other words, whatever amount that we are adding onto the cost to get our selling price. That is your basic equation. So cost plus the markup equals the selling price. If the question is, and they tell you the markup is X percentage on cost, then we take cost as the 100 plus the markup percentage, and that gives us then our selling price, which will be 100 plus whatever the markup percentage was. Okay, so that is cost plus markup, or you can also say, they say markup on the cost. Then if they say the markup is on the selling price, if they say the markup was 20% on selling price, then your cost is going to be 100 minus whatever that percentage is that they've given you, plus whatever that markup percentage is that they've given you, and then your selling price is going to consist of, is going to be your base of 100. So it all depends on what is your base. Did they say it's markup on cost? In which case your cost is your base and you put the 100% under cost. If they say it was markup on selling, then selling is your base and you put the 100 under selling. But your basic equation, cost plus profit equals selling, is exactly the same. So if the markup is on selling, then you're going to, and the markup is 20%, then cost must be 80%, so 80 plus 20 equals 100. If they say it's a 20% markup on cost, then cost is going to be 100, and it's going to be 100 plus 20 equals 120. And then you're going to use those proportions to do your calculations. So in this first one, I don't know if I'm going to fit this next to each one here. Let's just try. The markup is 25% and it's markup on cost. So that means my cost is 100% and I am going to add 25% of the cost to get my profit, and then the selling price. So 25% of the 5,000 Rand is the profit or the markup, and 5,000 plus the profit will equal my selling. Remember here, okay, we've got cost price plus profit equals selling price. Okay. So if you have a look at the bottom, it's this first one that will apply. So it's going to be 25% of the cost. So 5,000 times 25%. And then you're going to, okay, equals the profit. And then you're going to add A to the cost price in order to get B. Then the second one, sorry, I can't quite get to the lines exactly. The second one says the markup is 12%, but it's 12% on selling price. So that means the second one over here is going to apply. So 12% is our profit percentage. So that means here, this is going to be 12. Selling price is 100. So cost is going to be 100 minus 12. Okay, so let's put it under here. Oh, sorry, this doesn't always. Okay, that means that 88% plus 12% will give me my 100% selling price. And the selling price is 100 because it's a markup on selling. So my profit is 1245. Okay, so here we put the profit under the profit column 1245. And we have to calculate the cost price and the selling price. So if 1245 is 12 parts, and I want 100 for the selling price, I'm going to take 1245 times 100 over 12 will equal a selling price, and then selling minus profit will give me whatever the cost price is. Okay, do you see how I've used these proportions? You write 100 under the selling price, you write 12 under the profit markup, and then you calculate that this must be 88. And if I wanted to calculate the cost, I would say 1245 times 88 divided by 12 over 12. That will give me a cost price. Then this third one again is a markup on cost. And in this case, they have given us our selling price, the actual rand value. So markup on cost, I know that my cost is 100. I know that my profit is 30%. So 100 plus 30 equals the selling price is 130 parts. So my 20367 is 130 parts. So if I divide that by 130, I will get 1 part. Or you can also write it like this, times 100 over 130 will equal the cost. And 20367 times 30 over 130 will equal the profit. Okay. So here we had 100 cost, we had 30 as the markup, 100 plus 30 equals, and we had 130 as the selling price. We were given the selling price, so we put the 20367 under the SP column. And then if I'd say 20367 multiplied by 30 over 100, or multiplied by 100 over 130, sorry, 30 over 130, or 100 over 130, then you can calculate those two amounts. Then these last two are also on selling, so they would work out exactly the same as the second one that we did. So they have given us the cost price, 75% on selling. So that means the selling is the 100. 75% goes here, which means 25% goes to under the cost. So you've got 25% plus 75% equals 100%. And then the last one is 20%. So that's exactly going to be the same. We've got 100, we've got 80% plus 20% equals 100%, because when it's on selling, the selling must be the 100. So here you would, for the 75, you would say 500 multiplied by 75. Sorry, that's the cost price. What are we going to say? Let me go get down here. Let's just write this for you. The 75, we've got, and this is on selling. I'm running out of space down here. You would have 25 under the cost column plus 75 under the profit column equals 100 under the selling price column, because our markup is on selling. The 500 that they've given us, let's go down one more row, is the cost. Oh, that doesn't work because down there. Oh, sorry guys, I'm trying to, okay, I can't get that. The 500 is then under the cost column. Okay, so the 500 is under the 25 part. So we say 500 multiplied by 75 over 25 will give me the cost, and 500 multiplied by 100 over 25 will give me the selling price. And the same thing with this last one over here, where it's 20%. We would have 80 under the cost, 20 under the markup, and 100 under selling. The 3750 is the selling price, which is under the 100 column. So to work out my cost, it would, excuse me, it would be 3750 multiplied by 80 over 100. And to work out the markup, it would be 3750 times 75 over 100. Okay. And guys, again, you've just got to keep practicing. You won't get this right without practicing them over and over again. So take this table again and do these questions again and keep doing them until you understand. But use this little trick that I've showed you here of writing down on your paper cost plus profit equals selling. And then underneath that, you're going to write the 100 under cost if it's a markup on cost, or you're going to write the 100 under SP if it's a markup on selling. The markup percentage will always go under the profit column, and then you've got your proportions to do your fractions to work out whatever the missing number is. It is just a fraction calculation, which you guys mustn't get afraid of. These are fraction calculations that they taught you in junior school. So just have some confidence that you do know how to do these calculations. And don't be afraid of them, but you have to practice. So question 3, obviously here it would have varied depending on what invoice you guys found. I was very happy to see that a lot of students found all kinds of different invoices, and they gave really good examples, and most of you got your answers correct in terms of the excluding and including VAT, and are there any zero rated items, name and VAT registration, all of that. And then also this, is it in a full or an abridged tax invoice? So the only places where students sometimes got the answer wrong is that the invoice is not automatically an abridged invoice if it's less than 5,000 Rand. You have to look at the information presented on the face of the invoice. If they have got the customer's VAT registration number and the customer's details on there, as well as all the other details, then even though the amount might be less than 5,000, it is still a full invoice because all the customer's details do appear on the invoice. It's just that the company is not obliged to provide a full invoice if the total selling amount is under 5,000 Rand. But sometimes it is a full invoice even if the amount is less. Some companies, their computerized systems just automatically print out full invoices, and they do get that information from the customer at the time of the sale to fill in on their computer program. Okay, so these answers here would depend entirely on what the invoice was that you prepared. Then 3.5, most of you got these correct. There were very, very few students that didn't get this. Input VAT is going to be a current asset because that is the input is an asset because you are allowed to claim the VAT back. So that means it's a receivable in your books until SARS pays you back. And because it's an asset, it will increase on the debit side. So then that leaves our output VAT obviously then as being a current liability, because the VAT that we add onto the invoices that we send to our customers is VAT that we owe to the receiver. So if we owe it to somebody else, it's a liability, and we know that liabilities increase on the credit side. Then in our question 4, you're the bookkeeper of Uni Bookstores and the owner is Gifts Atoli. The business is a registered VAT vendor. That's important to take note, and also trades only with other registered VAT vendors. So that immediately tells us that when Uni Bookstores make sales, they are obliged to add VAT on unless it's an export, in which case it's exempt. And if they purchase goods, there will be VAT, input VAT included on that purchase unless the goods that they are purchasing are zero rated or exempt items. And if it is a standard rated item, but it is a non-allowable item, then that just means they're not allowed to claim the VAT back when they record that item in their in their cash book payments or petty cash book. So 15% VAT, and all amounts are inclusive of VAT unless VAT is not applicable, and VAT would not be applicable in the case of an exempt or zero-rated transaction. So here's all our journals that we've been given. And remember, if you go through the NSS session that I put up for you guys prior to the due date for the assignment, I did mark off for you with all of these transactions which of the journals they belonged in. So you had to, in 4.1, analyze each of the cash receipts. So they gave us the 4, and we had to put these. So these headings here they've given us is for a cash receipts journal. And what they wanted us to do was to break it down. Sorry, not the cash receipts journal itself. It's a cash receipt, but they want us to break it down under the accounting equation. Okay, under the accounting equation. So you had to correctly identify the name of the general ledger account that was going to be debited and the name of the general ledger account that was going to be credited. And then if it was an asset, is it increasing or decreasing, and etc. The same. You know the drill by now with these analyzing under the accounting equation. So 3, 8, 11, and 23, let's just go and take a quick look at that, and then we'll look at the answer. So 3 is we purchased trading inventory for cash. So we paid cash from Great Books wholesalers for 56,000 Rand. So that's the total amount that we of the purchase. But because we bought books for more than 50,000 Rand, we were given a 5% trade discount, and it says here round to the nearest rand. So also in your information, I've given you the question. I can't remember the question number offhand now, in your textbooks, where it explains the difference between trade discount and settlement discount, and where you do those calculations. It is question 5.2 on page 142 in your textbooks. Okay, so that we know what we're doing here. We purchased from Great Books 56,000 minus 5%. Then what was the next one? 3, 8, 11, and 23. So under 8, cash sales. So we're receiving cash because we made a cash sale. CRR is our cash receipts register or cash receipts roll. Cash register roll, and all books are sold at a markup of 25% on selling price. So 25% on selling price, remember our rules. That means that our cost is going to be 75. 25% is going to be the markup or the profit, and our selling price is going to be 100 parts. The amount that they've given us is the 28,200 excluding VAT. So when you do this calculation, you can do it in 2 ways. You can either take the 28,200 and add the VAT on to get the total amount that would go under your bank column. Then they've already given you the excluding VAT amount, which is the amount that goes under your sales column. And then in the cost of sales column, you've got to calculate then what the amount of the profit was. So because this is 28.2, they've given us the selling, that's 100 parts. So the 28.2 goes under this column, the selling column. And in order to work out the markup, it is then 28,200 multiplied by 25 over 100. Multiplied by 25 over 100 to calculate the profit figure. And if we wanted the cost, it would be 28,200 multiplied by 75 over 100. And that will give us the cost. And it's the cost that we want in order to put under our cost of sales column. So 28,200 multiplied by 75 over 100, that will give us our cost. 8, 11, and 23. So transaction 11 is also a cash receipts, cash register. All books are sold at a markup of 25% on the selling price. And in that case, they gave us the including VAT amount. So this is the amount that would go under the bank column. And you then have to calculate 2280 divided by 1.15 will give you the excluding VAT amount. Or you could also say 2280 multiplied by 100 over 115. And that will also give you the excluding VAT amount. And then obviously the including minus the excluding is equal to the amount of the VAT. And that's how you get the amount of the VAT to go under the VAT column. And then transaction number 23, received quarterly interest on our fixed deposit. The amount was directly deposited into the business's bank account. So that just means it doesn't go into our analysis of receipts column. It goes directly into the bank. And it's interest. So there is no VAT. Interest is an exempt, VAT exempt item. So the 1368 will go into the bank column, and it will also go into our sundry column where we then allocate it to interest received. You must indicate that it's interest income or interest received, because remember, interest could be interest paid or it could be interest received. So you must, in the name of the GL account, either write the interest paid or interest received to income, whether indicate whether it's an interest expense or whether it's interest income. So let's go and have a look at our table. So hopefully you guys can see this. I know on YouTube these tables don't come out very clearly. I think it's just the quality that they upload as they don't upload as high definition files. But what we've got here is for the first transaction on the day is the 3rd. Account debited is bank, account credited is capital, plus assets 10,000 plus owner's equity 10,000. The transaction on the 8th, account debited is bank, account credited is sales, assets is going to be plus 32,430. Owner's equity is going to be plus 28,200. So bank increases by the full amount of the sale. Owner's equity increases by the amount excluding VAT. And then you also have to remember to put your output VAT under accounts credited, output VAT, with the VAT amount under the liabilities column plus 4230. So remember the right-hand side and left-hand side of our accounting equation, assets equals owner's equity plus liability. So if we look at what we've done here, 28,200 plus 4230 equals the left-hand side of the accounting equation, 32,430. And then we know our accounting equation is in balance. So remember, if the business is registered for VAT, if we're buying or selling for VAT, then our sales must include an output VAT line and our purchases must include an input VAT line if VAT is applicable. Then also, because it's a sale, we've got to have both transactions. Number 1, the sales transaction, and number 2, the cost of sales transaction. So the second part of the entry for the 8th is then debit cost of sales, credit inventory, and this must be then for the cost amount. So 28,200 multiplied by 0.75. So we want 75% of the excluding VAT amount, and that gives us minus 21,150 under assets and minus 21,150 under owner's equity. Then the transaction on the 11th is also a sale, so we're also going to have, first of all, the sales, the journal entry for the sales transaction, and second of all, the journal entry for the cost of sales side, the inventory transaction. So again, it's going to be debit bank, credit sales and output VAT. Assets will be for the including VAT amount plus 2280. Owner's equity will be for the excluding VAT amount plus 1983. And then output VAT will be for the VAT plus 297, goes under liabilities. And remember, output VAT is a liability because we owe that VAT to the receiver. We've collected that VAT on behalf of the receiver of revenue when we process the sale to our customer. And then the second part of the entry, debit cost of sales, which is an expense account, and credit inventory, which is an asset account. So 2280 multiplied by 0.75 minus 1710 assets minus 1710 owner's equity. And then the interest received, number, the last one on the 23rd, debit bank, credit interest received. And we are under the assets column plus 1368 and under the owner's equity column plus 1368. And then 4.2 wanted cash book payments. And for this one, they didn't tell you which dates you had to do. You had to identify which of these transactions were cash book payments, and I did that for you in the NSS prior to the due date. So cash book payments, you should have had, let's just use the highlighter, day 1. The monthly installment on the loan was paid by debit order. On the 2nd, we paid by EFT to draw money for petty cash. Then on the 3rd, we paid Great Books for the books that we purchased from them. On the 21st, we paid the company called Textbooks and More for trading inventory that we purchased from them. And on the 26th, we paid by an electronic funds transfer Jacques Nienaber for the monthly rental of the bookstore. And remember that monthly rental, because this is business rental, it does include VAT. So that would be, that 4,000 Rand would be inclusive of that. And then the last one on the 31st, we paid wages to the casual workers. So that's 8,800. And remember, wages and salaries will never include VAT. Those amounts are not a good or service that the company buys or pays for. So that will never include VAT. Because remember, it's only goods or services that we add VAT to. And wages is not a goods and it's not a service that we are providing. Okay. So let's go and have a look at 4.2. So in this one, we had to fill in the actual cash book payments journal, as opposed to 4.1, where they wanted us to break it down under the accounting equation. So day 1, remember what goes under this first column, details, name of payee. It must be the name of the company or person that you are paying the money to, not a description of what you bought, but who did you pay the money to. And if you paid cash for something, you must insert the word cash. Okay. Then under the main column, which is bank, which remember, this will always be the including VAT amount. Put the including VAT amount. Then the VAT itself goes under the next column, and then your inventory and your amount under the sundry accounts will always be the excluding VAT amounts. So only if the transaction was inventory that you purchased would you put it under this inventory column. So only 2 of the amounts that we paid was inventory that we purchased. So they go under the inventory column. And if we use the inventory column, then we don't need the sundry accounts column because inventory has got its own column. Remember, this is the general ledger account inventory that's headed there. And then for the other 3 transactions, we put those under the sundry accounts column because I didn't have a column over here for loan. I didn't have a column over here for rent expense. And I didn't have a column over here for wages. So therefore, I needed to use my sundry accounts. The amount excluding VAT goes under the amount. And then under details, I put the name of the general ledger account. What is this? Cash book payment. So bank is getting a credit, name of the general ledger account that I'm going to debit. Okay. So there are the amounts, and hopefully by now you guys are getting your including VAT, VAT and excluding VAT calculations correct. And then, as I said, just remember over here, for the loan as well, there's no input VAT for a loan because that's a financial transaction which is also exempt from any interest. Petty cash, we are merely drawing money out of our bank account to put into the petty cash box. That's not a sale transaction, so there's no VAT involved there. And what else? There is VAT because we purchased inventory from a VAT registered vendor. And in this one here, there is VAT because we purchased inventory from a VAT registered vendor. And in this last one with the rent, there is VAT because this is business rental that we are paying to a VAT registered vendor. Our landlord is a VAT registered vendor because they didn't tell us otherwise. So that's, oh, and the last one, wages also. There's never VAT on wages or salaries because that's not a sales transaction. And then the last one was the petty cash journal. So the difference between our cash book payments comes into this column over here, the details column. In your cash book payments, this first details column, you must write down the name of the person or company to whom you are paying the money to. And if it's cash that you withdrew for something, you must write the word cash. In the petty cash journal, what goes under details is a description of what you bought. So here we are going to write petrol for the owner's vehicle or petrol for gift. Okay, that's what we purchased. The second one was kettle for staff use. You can see they've put the name of the person that we purchased it from as well, but in most cases in the petty cash book, you don't even do that. You just write down what did you buy, because the petty cash slip will be attached and you'll be able to see the name of the business on the petty cash slip. Kettle, and the last one is internet fees. Okay, they told us we paid internet fees on the 28th. Bought data from MTN and we used petty cash. So a lot of you put data, that's also fine. And then again, your petty cash column, because that is the main column of the journal, that will be the including VAT column. Then next door to that, you then calculate the VAT amount, and then everything to the right-hand side of that will exclude VAT. Staff refreshments, okay, will exclude VAT unless VAT is not applicable or non-allowable. So staff refreshments is a non-allowable supply, which means that if we pay for staff refreshments, we are not allowed. Where's our staff refreshments column? We are not allowed to claim VAT. So nothing that we bought here was staff refreshments, but if we did, there would be no VAT. Okay, no VAT. Petrol, we know, is a zero rated item. The kettle for staff use, there's no VAT to claim there because it is considered to be, because it is for staff use, it is considered to be entertainment, and therefore we are not allowed to claim the input VAT. And then buying data from MTN, that is a normal purchase of goods or service, so that will be included in that one. Because the petrol that was purchased was for gift herself and not for the business, we have to charge that to the owner's drawings account. So under sundry accounts, under details, we write the name of the general ledger account that must get credited or debited. This is petty cash, so we are crediting petty cash and debiting these other accounts, so debit drawings. And for this kettle that we purchased, we are debiting the account called equipment, because when we purchase a kettle or some other item of furniture or fittings or computers or equipment, we use the name of that particular asset category to add that item to. So even though we are buying the kettle and it is for staff, we don't charge it to entertainment, we charge it to the asset account because it's a physical piece of equipment that we are purchasing for the business. But we are not allowed to claim the VAT back. So the full amount of the cost of the kettle must get debited to the equipment account, no VAT deducted. Okay. And then for our question 5, the last one, here we got the cash book receipts and the cash book payments, but they had only given us the column, the totals. Okay, these are the totals of our 2 cash books at the end of the month. And they wanted us to calculate the missing amount, A and B, for bank. So let's have a look at this, cash book receipts. So remember, I've always told you that the main column of your cash book always includes VAT. So the VAT plus the expense amount, or the VAT plus the excluding amount, will equal that main column. Sundry accounts, this will also be an excluding VAT amount. And then remember, your cost of sales is completely separate from your actual cash book receipts, debit bank, credit, output VAT and sales, debit bank, credit, output VAT and sundries. Cost of sales with this column here, remember, is its own separate journal entry where we are going to debit cost of sales and credit inventory. So this 72,740 has got nothing to do with these amounts over here. this is its own separate journal entry. So the total for A is going to be our output VAT, which is the VAT amount plus the two excluding VAT amounts, will equal A, which is the total including VAT. Then for our cash book payments, again, our bank column is going to be the including VAT amount, which is the main column of the bank account. So you can almost say that if we put an equal sign over here, okay, bank is the left-hand side of the journal entry, and these columns over here are the right-hand side of the journal entry. So our debits must exactly equal our credits. So this is cash book receipts. So bank is getting the debit, output VAT, sales, and sundry accounts are all getting the credit. So these three on the right-hand side added together will equal what's on the left-hand side. And this is exactly the same on this side, excepting because this is the payments, our main column bank is getting a credit, which means that all the columns on the right-hand side will debit input VAT because it's an asset. I'm going to debit trading inventory because I'm purchasing an asset, and I will debit whatever my sundry amounts are depending on what that transaction is. So all of these amounts on the right-hand side added together will equal the left-hand side of my journal entry. So for cash book payments, input VAT plus trading inventory plus sundries will equal my amount for B. That was surprisingly lots of errors on that one, which I must admit I was quite surprised because I didn't think that, I didn't realize that students would not, that's quite a, I can't get rid of that now. It's quite a basic principle. Your journals, your main column equals the columns on the right-hand side because it's the journal entry that we are producing. Here we are going to credit bank, debit input VAT, debit trading inventory, debit all my sundry accounts. Okay. In your own words, explain why we need an analysis of receipts column. So there were some weird and wonderful answers to this one. So remember, as we've discussed, your analysis of receipts column acts like a till for the business, an actual cash cash receipts till, which means when someone comes to the actual, to the actual business and they pay money into the business and you put it into your cash register and it stays there until you've got time to go and do your banking, in which case then it comes out of the till and you bank it into your bank account. So the cash receipts column is a holding column that we hold the amount that we've received there until we can go and do the banking. And then also, as your textbook says, we also then have got the benefit that the analysis of receipts column gives us all of the details of each of the receipts that we did, that we received, broken down individually. Because if we go and look at our bank statement, the bank statement will just have one credit amount on it for the total amount that we banked when we did the banking. So we might have 10 different receipts in our till before we go and do our banking. We'll be able to pick up the details for each of those 10 in that analysis of receipts column. In our bank statement, I will just see one credit amount for the total amount of the banking of those 10 items that I did. And then prepare the following general ledger accounts. So remember, your general ledger is your T account for March balance all accounts properly at the end. So that just means you must balance them, indicating what amount is going to be carried forward or brought forward at the end of this current month for the beginning of the new month. And they wanted bank and they wanted trading inventory. They gave us our opening balances. So bank has got a favorable opening balance of 300,000. So obviously we have to post these totals from our cash book receipts and my cash book payments to my T account bank at the end of the month once my cash books are completed. So let me just write in, where's the answer here, what you should have got. So your total for column A, this amount here, should have been 168,896. And your total here for your cash book payments under bank should have been 207,448. So we're going to post those two amounts to our bank general ledger account, which has got an opening balance of 300,000 that is favorable. So here is our T account. Here's the T. Remember, on the left-hand side, I've got date, details, folio amount. On the right-hand side, I've got date, details, folio amount. And if I am going to debit bank, I'm going to put the amount in the transaction on the left-hand side. And if I want to credit the bank account, I'm going to write that amount down on the right-hand side. So opening balance, date, first of the month, details, balance, and under folio you put their brought down and then the amount that they gave us. So bank is an asset. And we know from our red click that if I am going to increase an asset, I'm going to debit it. So then I know my favorable bank balance must go on the debit side of the bank account. The bank amount from my cash book receipts, 168,896, is going to increase my bank amount. So that must go on the left-hand side, on the debit side, because that is increasing bank. Date, the last day of the month. Details, total receipts, which is what we always use when we are posting the totals. Oh, sorry, my totals from our cash book receipts. Under bank, I just put the word total. And the reason that we can't put the name of the general ledger account getting the credit is because this is coming from a total of my entire cash book receipts, and the credits would have gone to output VAT, to sales, and to various different sundry accounts. And we don't have space over here under details to write down all those different accounts that are credited in the cash book receipts. So the convention is that we just write the words total receipts. You must then put CBR under folio or CBJ, cash book receipts journal, and then the amount of the total under the bank column. And then for our cash book payments, because when we make payments, that total that we are going to pay is going to decrease the amount in my bank account. The 207,548 must go onto the credit side of my bank account, indicating that that is the amount that I paid out of my bank account. Last day of the month, because this happens at the end of the month after we've closed off our cash book receipts journal and cash book payments journal. Details for the same reasons is going to be total payments, folio cash book payments, and then the total amount in the bank column. Then they asked us to balance the account. So remember, when you balance an account, you must total the left-hand side and total the right-hand side, and whichever amount, which before we did the total on the right-hand side, we only would have had 207,548 on the right-hand side. But when we total the left-hand side, we've got 468,896. So the amount that is the bigger amount, we write that down on both sides because the left-hand side must balance to the right-hand side. So we put those two amounts down, and then we subtract the 468,896 minus 207,548, and that is how we work out what the balance in our bank account is, because we know that the balance is a debit balance because the debits at 468,896 are more than the credits, which are only 207,548. So we do this little balancing calculation to calculate how much more are the debits than the credits. So we take the total debits, 468, minus the total credits. The difference is 261. So that means that the balance carried forward, or the balance brought down, as at the first of the next month, is going to be 261,348. Okay, which is the total debits minus the total credits, as at the end of March. And then you do the exact same thing for the inventory account that they asked us to balance. So with the inventory account, they told us the opening balance is 13,000. So inventory is an asset, and the balance in your inventory account is always going to be a positive balance because you can't have a negative amount of inventory. So they don't have to tell you that it's a favorable opening balance. Inventory is always going to be on the debit side because it's an asset account, and assets increase on the debit side. So the 13,000 you would have then recorded on the left-hand side, the debit column. Remember, this is my debit side. This is my credit side. The left-hand side is always the debit side. The right-hand side is always the credit side. Inventory, you need to know that it is an asset so that you know whether to debit or credit the amount. And then we're going to go to our cash books to see what entries affect inventory. So over here in our cash book receipts, we know that the cost of sales gets debited to cost of sales and credited to inventory. So we're going to take our 72,740 and put it on the credit side of the inventory account, indicating that I am crediting inventory with the amount of 72,740. Then under the details column, I write down the name of the general ledger account that is getting the debit, which is cost of sales. And I must write down the folio, which means which subsidiary journal did this entry come from. And it came from the cash book receipt, so I must write down their CBR. So this then tells me that on the 31st of March, at the end of the month, I debited cost of sales and I credited inventory with the amount of 72,740, and that the source of this entry was the cash book receipts. Then I go to my cash book payments. Here I've got a trading inventory column. I purchased trading inventory of 157,253. So when I purchase inventory, that means my trading inventory general ledger account is going to increase by that amount. So 157,253, I must debit inventory with that amount to indicate that inventory is increasing. Under the details, I write bank because in my cash book payments, I credited bank and debited trading inventory. So 31st of the 3rd, credit bank, debit inventory, and folio tells me where did this entry come from. its source was CBP, the cash book payments. There were no other entries that we had to post to our T account inventory, so we can now balance the account. So once again, we add up the left-hand side of these amounts that are already there. We get 172.53 on the left-hand side. And on the right-hand side, I've only got 72.740. That means that the debit side is greater, which means that my balance is going to be brought down on the debit side. But in order to work out how much that balance is, I need to subtract my total debits, 172.53, from my total credits, 72.740. And remember, we do this, convention says, add up both columns, left and right. Whichever is the greater amount, we write that amount down on both sides. And then we work out what the difference is on the side with the smaller amount. And then we carry that amount down to, just have a look these a moment, just have a look at my memo. It looks like they had a problem here. Yes, okay, this should have been, and I've corrected it on my side. That's not 188. The balance brought down was 97,513. Just see if I can get rid of that. Why does that not rub out? Okay, don't know what I've done there, but it's disappeared. Let's write it in there again. 97,513 is the balance brought down. That was just a typo on the memo. Okay, so also, guys, this process of balancing off an account at the end, when they say balance the general ledger account, just practice it. It's just those simple steps. Step number 1, post all the amounts for the month to the general ledger account, which we don't forget your opening balance. Okay. Opening balance NB, don't forget that. So we put our opening balance in, we posted our amount from the cash book payments, we posted our total from the cash book receipts, and then when we've done that, the second step is then add up the left-hand side and the right-hand side. And then write down the bigger, the largest amount on both sides under the existing entries, if you can understand what I mean. So here's our existing entries, and underneath them on the same line, we write down the total of the larger amount. And then number 4, on the side with that had the smaller total, subtract the difference. So you understand what I mean by subtract the difference. What's the difference between the entries that were already there and the total that we brought from the larger side? And then step number 5, carry the difference, which equals the brought down amount over to, it will always be on the opposite side. So I'm going to write down here over to the opposite side as the opening balance for the new month. Okay, so hopefully that will help you. This balancing story is in your textbooks. I have indicated it also in your lesson plans, and I did go over it in your NSSs as well. So all of this has been done with you guys before, but at least now you can see what the various answers should be. And then they also asked for the capital account. So your capital account is easy. This one over here, they gave us the balance, and capital account is a proprietary account. Remember, it's one of our proprietary accounts. And again, if you remember your dead click, capital is on the credit side. Credit, liabilities, income, capital. Capital increases on the credit side, so our balance will always be a credit balance. And then from our cash book receipts, over here, sorry if I must give you this. Capital, assume an opening balance of 500, and that included in the sundry accounts in the cash book receipts for March. So in other words, included in the 60,000 that we put under the sundry column, part of that 60,000 is an amount of 60,000 exactly that the owner contributed. So we know that the capital account increased by 60,000. So because capital is increasing, we write the 60,000 on the credit side. We write down the name of the account that is going to get the debit under the details column. The date, it's the last day of the month because we're posting this from our cash book receipts at the end of the month after we've totaled it up. So date the 31st, details is going to be bank, folio is cash book receipts because that is the source of this posting, and we are going to credit the amount of 60,000. And then they're asked to balance, so we must add that up. So when there are we've only got credits, there's nothing on the debit side, so all we have to do is just add up those two to get 560, and that is then automatically capital account balanced. The sales account is also going to be balanced in exactly the same way. There's nothing on the debit side of the sales account. Sales is income, and sales always is going to be a credit. Click, income, credit. So again, they gave us the sales. Our opening balance was 236,405 at the beginning of March. So we write down the opening amount on the credit side because sales are always credits. Nothing will appear on the debit side of your sales account. Nothing will ever appear on the debit side of your capital account. And then we are going to record the sales from our cash book receipts, sales column from the cash book receipts, the 94562. We are now going to post that total to the sales general ledger account. Must go on the credit side. The account that's getting the debit is going to be bank, because in our cash book receipts we debit bank and credit sales, and the source is cash book receipts. And then again, there's nothing on the debit side, so in order to balance the account we only have to add up those amounts on the right hand side. Okay guys, so that is then the full walkthrough of your assignment 2. I'm going to finish off this recording now so that it doesn't go on too much longer, so that I've still got time to post it, because it takes quite a while to get it up, to download it and to post it for you. And then I will let you guys have it. Okay, so all the best with the rest of your revision, guys. And remember, let me have any questions you've got this coming week as you guys revise. Okay, good luck, guys. And I'll chat you guys all again soon.